How's it going, everybody? Michael Silva here. So Fed Jerome Powell came out today and was testifying. We're going to get some more Fed talk come tomorrow. He did mention that higher interest rates could cause a possibility for a recession. What took place in the markets when he came out? Well, the TNX, the 10-year yield on this weekly time frame, started breaking the low of the prior reversal type candle that we had discussed, and we're starting to see rates back off a little bit, which sent investors running for the longer dated treasury bonds. The TLT was up. Now it's up 1% on the week, breaking through this reversal candle. We'll see if there's any momentum to this, and if we do get follow through, right? The week's not over yet, but it's looking like it's trying to follow through as of now. If we take a look at yields across the board, look at, an inverted yield curve indicates that we may potentially have a recession around the corner, right? And we had that yield inversion in April on the 10 and 2. But we've been saying that we want to wait for that Fed staple curve to invert, and you can see it's continuing to flatten out here. This is the 10-year and the 3-month. We've had, various curves and yields invert already. Now I'm just paying attention to these ones, the 10 and 3 here, 10 and 3 month. To see if this will continue to flatten out and head towards inversion. Oil took a big hit. It was down around 7% intraday, but started to recover more throughout the middle of the day. It hit that 100-day moving average, came out a little bit lower, but did manage to hold on to this trend. We'll see here if oil is this a sign of some more sell side to come, or if this is just taking a breather in an overall uptrend. We will see here soon. The dollar continues to just kind of perpetuate sideways and consolidate in bullish context. If the dollar starts taking off, I'm sure that we're going to see some more downside momentum in the markets, as well as the possibility for more downside in gold. Gold hasn't gone anywhere, which is one, a good thing, and two, not a great thing, right? So first and foremost, why do I say that? Well, the dollar, right? When the dollar is rising, that typically brings gold down, and the dollar's been rising throughout 2022, and well, gold has been holding up rather well in 2022. 2022, it opened up over here, and we're just slightly up on the year. So we'll see if the dollar breaks to the downside, if that's really what's going to set gold off to start moving up, and see if the dollar continues to hold up, if gold's going to manage to stay within this kind of trend here. You can see it's just a neutral trend. It's below these key moving averages. Not the greatest looking daily candles overall. It was up slightly on the day. So we need a little bit more time here. This could be basing, but it's very difficult to just place a trade right here. I would like to see, if it starts breaking down from here, buyer beware. But if it starts breaking up again past that 50-day moving average, that could be quite bullish for the price of gold. Overall today on Wall Street, what took place? Well, the indices were down. They finished down rather flat on the day, right? The big gap down in the overnight, but they managed to recover quite a bit. If we look at the 11 sectors that make up the S&P 500, more defensive names pushing the top. S&P 500, right? It did really good today overall, but just struggled to kind of push further, and that was really because of this laggard over here, energy, down 4% on the day. And, energy is a small weight, but just be mindful that energy has been up, 40, 50, 60% on the year at a particular point in time, and that created some of these big, market cap names that weren't big market cap prior. So like, for example, Chevron, ConocoPhillips, those became some mega market cap names that we just, if they start getting hit, it could really kind of, slow down the S&P 500 from trying to find its footing. Keep in mind, everybody, volatility indexes are still very high. So Russell volatility, it closed at 35.43. Once again, I got to reiterate this. This is above a 30 marker. This is where things can get, quite rough in the markets, to say the least, right? This is where crashes could potentially occur, okay? And we just constantly seen this trend to the upside. It's down slightly on the week, so we'll see here if we get some relief, but it's still at a high reading. NASDAQ volatility too as well. It closed at 35.94. This is really high volatility levels, and honestly, it looks like it could potentially fire off, at any time, so just be mindful that, hey, volatility is still trending, which could put a lot of pressure on the markets, create a lot of fear, a lot of doubt if this thing starts rocketing off. On a decent note, right, the VIX kind of came down below 30. It closed at 28.95, but clearly you can see it's still trending, putting in higher lows and higher highs right here. Surprisingly enough, as the S&P 500 has been coming down, we still haven't got a pop above that 40 level, which if you date back through history, every bear market that we've seen some capitulation event that shot us past that 40 level, and we just haven't got it yet. Today, if we look at the S&P 500, 500, we did tag the upper expected move, and we started seeing, what do you know, resistance up in that area. Some sellers stepped in, it faded, ended up closing slightly lower on the day. On a good note, on a good note, the momentum indicator, the MACD, is starting to curl itself over here, and you can see there's a low, right, a low and a lower low. However, the momentum indicator is putting in actually a higher low. So that's a positive sign. But remember, these are lagging indicators, okay? So take it with a grain of salt. Not the greatest looking candle. Looks like a reversal type candle. We'll see what the remainder of this week brings and if Powell throws any wrenches in our face come tomorrow. The Qs, very similar type looking day. Almost tagged the upper weekly risk range, didn't quite make it, but then began to fade. The momentum oscillators look like they're turning back around, which is nice. RSI still below that 50 marker. Not the greatest looking candle overall, right? We're just in this chop bucket as it stands, just like we were in a chop bucket here, and it broke down, right? Contraction leads to expansion. Expansion leads to contraction. Contraction will eventually lead to expansion. Is that to the upside or is that to the downside? Well, the trend still remains lower highs and lower lows. So one would say the risk is still obviously to the downside. If we take a look at the IWM, down on the day as well. Gap down, recovered just like the other index products. You can see volume's been dying off. That's a kind of a, we'll talk about it here momentarily, but just volume on these days up, right? Volume has been dying off. That's, not the greatest look, but we're still holding up from the previous low a few days ago, okay? Not nearly close to the upper weekly risk range that we caught in the other index products. Perhaps, that's a sign for us saying, hey, small caps aren't making it nearly as far as the other index products. Maybe, we don't have much of a bear market rally here. It's a little too early to tell at this given time. If we do take a look at the NASDAQ composite, this is day 3 now of the attempted rally, right? This is something that I'm tracking on Twitter. IBD went back in history to the 1880s, and looked at no bear market has ever started without a follow-through day. So what I'm tracking now is for that follow-through day. If you don't know what that is, in short, you're looking for a day that's up 1.25% or greater, roughly around 2%, and with more volume than the prior trading day. Typically, a follow-through day happens anywhere between day 4 to 7 of the attempted rally. And so we're on day 3. Tomorrow is going to be day 4. So, hey, if we have a day 4 tomorrow and the day ends up, up 2% with more volume, that would be our follow-through day. I don't know if that's going to be taking place or not, right? This is just kind of chopping around sideways, and this will reset, right? This will reset because we can have, day 4, day 5, day 6 or whatever, and then day 7 might have a follow-through day. But we just need to watch to make sure that this low right down here isn't taken out, okay? So that is what we're keeping track of. I will say the momentum oscillator, same here. It's starting to curl back around, right? So that's a positive sign. It's still below 0. So it comes with some hesitation. RSI is below 50. Hesitation there too as well. Trend still remains to the downside. Let's look at the 15-minute time frame. This is now the second day in a row where we're closing above that 5-day moving average on the S&P 500. You can see we tagged, the weekly risk range to the upside, so that's a positive sign. It's also positive that we're here in the short term above the 5-day moving average. The longer we stay here, this will flatten out to start moving up, and then we could start finding potential trades here that can actually play out. As it stands right now, 380 is a level to keep a very close eye on, right? This level looks like it's going to be hard to get through, but if we can get through that, maybe that's an inverse head and shoulder, then that takes us to potentially fill one of these gaps up here. It's going to struggle to get anywhere past that 400 marker, in my opinion. The trend is, roughly beaten down, so we need to have it more time in play to see if we can even get up to this level. But as it stands right now, market participants are looking, from my perspective, it looks like they're trying to fade any sort of rally. So these rallies, they're guilty until proven innocent. So don't read too much into it until we get some really strong confirmation, which has just not came yet. And if you take a look at the Qs on the daily, the 15-minute time frame, second day in a row above that 5-day moving average. It is starting to incline now, so that's a positive sign. We did get that move to the downside to almost fill that gap. We didn't quite do it, and then we started rallying up higher. Could not quite reach that weekly expected move. Keep in mind, we still have, obviously, a lot of resistance above us, right? These big gap downs created some momentum to the downside. right? Expansion leads to contraction. Very similar type pattern, kind of looks like an inverse head and shoulder. We talked about weekly timeframes, yearly timeframes on the last two episodes. So, it looks like we're setting up for a bear market rally, but it looks like if that is going to be the case, it's not going to be as simple as just buying and holding, because clearly we're just getting some crazy gap ups, so we're getting crazy gap downs, crazy gap ups, crazy gap downs, crazy gap ups. We're going to get another crazy gap down tomorrow. I don't know, but as it stands right now, we are just chop bucketing around in the queue. So be careful, especially seeing how volatility is so high. If we take a look at the IWM, we are trading pretty much on the 5-day moving average. Once again, maybe slightly above it. We closed at 167.82. The moving average is at 167.74, so pretty much spot on it, just slightly above it. We'll see if we can continue to hold. The longer that we do, the better, right? This will start flattening out more. Perhaps we can start breaking away from this and start heading back up into this realm. But as it stands right now, right, we're down slightly in the after-hour session. We had that gap down. It filled this gap, just about filled the gap and acted as support, and we came right back up. So we'll see if Powell's going to bring any heat tomorrow. That's going to bring us right back down, because that's it's still a strong possibility that we head down. There's not really a great trade setup at this particular time. So it's a bear market. Be very careful out there. When it comes to bear markets, be careful picking individual stocks, right? It becomes a little bit easier to trade index products in bear markets, right? Because one simple, a way to look at it is you can really get leverage, right, using individual equities. They move significantly faster and further, whereas, the IWM, the Russell, the Qs, and then also the SPY, they typically, in volatile times, they move, from, 1 to 3% full ranges, and it's kind of, you can grasp that a little bit better than, hey, you might wake up and one individual equity is down 20% on a day. So just continue to be careful out there, continue to manage risk. If you can survive this bear market, trust me, when the bull market comes around, it will be great. All right, that's all I got for you on today's episode. Everybody have a wonderful